Love for accounting. In today's video, we will continue with the elements of financial reporting. Let's dive right in. We already know that in the second level of the conceptual framework are the elements of financial reporting. We have discussed assets, liabilities, and equity. Let's talk about the remaining elements, income and expenses. Income are increases in economic benefits during the accounting period in the form of inflows or enhancement of assets, or decreases in liability that results in increases in equity, other than those relating to contributions from equity participants. In short, an income item increases assets or decreases liabilities, increases equity, and is not an extra investment from owners or investors of the business. All these three criteria have to be fulfilled to make it an income. We will look at three examples. Example 1. Sales on credit. Of course, we know by common sense that when we sell goods, it is an income. Let's see if it checks all three criteria. Sell goods on credit means we now have trade receivables who will pay us later. This is an increase in assets. First criterion checked. The money we later receive ultimately belongs to the owner of the business, an increase in equity. Second criterion checked. This increase is not contributed by the owner. Final criterion checked. So it is an income. We will go faster in other examples. Example 2. Take out a bank loan. That means borrowing from the bank. We receive money from the bank. Assets increase. But at the same time, because of the loan, liabilities go up too. So criterion 1 is not fulfilled. Even though the third criterion checked, it is still not an income. Example 3. Owner gives his own vehicle for business use. We have more non-current assets, more investment, which increases equity, but it is from the contribution of the owner. So it is not an income. Expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrences of liabilities that result in decreases in equity, other than those relating to distribution to equity participants. It is essentially the opposite of income. The three criteria: an expense item decreases assets or increases liability, decreases equity, and is not a distribution to owners. Example 4. Pay rent. Using cash, we have less assets. This is ultimately borne by the owners, and it is not a distribution, so it is an expense. Example 5. Purchase of goods on credit, more trade payables, less equity, not a distribution. Cost of a business, similar to an expense. Example 6. Repay bank loan. Less cash at bank, less liabilities. Criteria 1 and 2 not fulfilled, not an expense. Example 7. Purchase of non-current asset, less cash at bank, more non-current assets, again, not an expense. Last example. Pay dividend, less cash at bank, less equity because profits are distributed to equity investors of the business. Last criterion not checked, not an expense. These examples seem tedious, but it is very important to realize a receipt of cash may not be an income and a payment may not be an expense. We need to keep this criterion in mind to make good judgment. Next time, we will look at the basis of modern accounting, the accounting equation.
I love accounting.